Dear viewers, welcome to this episode of Expert Speaks. A lot of NRIs have got properties. They keep buying and they keep selling the property. One of the problems NRIs face is they need to be paying a huge amount of TDS at the time of selling a property in India. Everybody is asking us the question, is there a way where we can lower this TDS at the time of sale of this property? We have found an answer for this. In our episode today, the expert of the week, Chartered Accountant, Mr. Ambergar, is going to tell you how you can reduce your burden of TDS at the time of selling of your properties. This is NRI Money Clinic for you, and I am Dr. Chandrakant, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
To talk about how you can reduce your tax burden with respect to TDS at the time of sale of property, guest on our channel today is popular faculty member, Chartered Accountant, Mr. Ambergar. Mr. Ambergar is co-founder at filemyreturn.co.in, which has filed tax returns for more than 18,000 people. Mr. Ambergar has 2 decades of experience. Mr. Ambergar is a second-generation chartered accountant in the family. File My Return is a sister concern of the famous NRI Associates, a chartered accountancy firm which is in existence for more than 40 years, and it has been started by Mr. Ambergar's father, Mr. Himat Rai. Welcome to this episode, Mr. Ambergar.
Thank you, Dr. Chandrakant Bhatt, for giving me this opportunity to come on your channel to address this question to your viewers.
Mr. Ambergar, NRIs have a feeling that they have a different way of taxation, a beneficial taxation when it comes to question of income tax. Now the question is, a lot of NRIs have got properties. They have bought properties, or they have bought properties before they become NRIs. A lot of people have got inherited properties. Does the taxation of sale of properties in India by NRIs, is it same as residents, or do they have a differential treatment, favorable or unfavorable? What does the law say?
Well, to answer this question, I would like to say that the property sale transaction, whether done by a resident Indian or an NRI, will always be subjected to provision of income tax law in India. Having said that, the short and simple answer is yes, NRI is liable to pay tax in India. And there is a difference between the tax rates applicable to resident Indian as well as NRIs.
Now, it's a common knowledge that when these large transactions happen on the sale of properties, even a resident Indian pays the TDS, tax deducted at source, or which is popularly known as withholding tax in many other countries, is there in India. Now, NRIs, how does the TDS apply in their case? Is it same as a resident Indian, or there is a different metric which will be applied?
No, the TDS deducted for the NRIs and the resident Indians are not same. When we talk about the TDS, that is withholding tax, for the resident Indian, the TDS deducted, that is withholding tax on the total sale proceeds, is only 1% of the total sale proceeds. I repeat again on that. Whereas if I talk about NRIs, the total sale proceeds, the TDS deducted is different. If the NRI is selling the property within 2 years from the date of purchase, in that case, the withholding tax will be 30% on the sale proceed, irrespective whether the NRI is having profit or loss. And whereas if the property is sold after 2 years of purchase, that is by the NRI, then the withholding tax liability will be 20%, not 30%. So now, addition to this tax of 30% or 20%, there is additional liability which the NRI has to pay. That is called surcharge and education cess, which is applicable depending upon the sale proceeds of the property. If I talk about the sale proceeds, I come to that point. Surcharge is applicable if the property transaction is between 0 to 50 lakh rupees, then there is no surcharge. If the transaction property value is between 50 to 1 CR, then the surcharge is 10%. And if the total sale proceeds is above 1 crore, then the surcharge is 15%. And on the total TDS plus the surcharge, the education cess will be 4%. So it will vary between 22.88% to 24% of the total sales proceed, irrespective of whether there is a loss or gain selling the property by an NRI in India.
Mr. Garg, while you gave your answer, you mentioned that there is a short-term capital gains tax or a long-term capital gains tax depending on the holding period. For ease of understanding of those people who are watching this episode, can you exactly tell what is a short-term capital gains tax and what is a long-term capital gains tax, and how does the tax percentage differs, or what are the points people have to know about the difference between these two?
Sure. Let me explain that. As I explained, when the person is selling the property in India, if he has bought the property 2 years back and if he is selling the property today, we have to first determine whether it is short-term or long-term in order to understand what will be the withholding tax on it. So first thing, from the date of selling, that is actual date of transfer of property in the name of the buyer. That is the date which we capture. If that date is after 2 years from the date of purchase of the property, then it will come under long-term. If the person is selling the property within 2 years from the date of purchase of the property, that is from the date of purchase of property and the selling date, that is the transfer date of the property in the name of the buyer. In that case, it will fall under the short-term category. And now coming to the next point, whether this short-term capital gain can be offset or not. Yes, short-term gain can be offset, provided it can be only offset against the capital losses which he has been carry forwarding from the back, or in case he has a current year losses incurred either from the equity or any sale of other asset. Whereas other option is he has to pay the tax on the short term. There is no other way to offset the short-term capital gain tax. If I'm coming to the long-term capital gain tax, yes, in case of long-term capital gain tax, there are options. There are 3 options. One option is that he buys a new property. Second option is he can offset against the losses which is coming from the short-term or long-term. It is not necessary that it has to be a long-term capital loss. It can be a short-term capital loss also. It can be a long-term capital loss also. Both can be set off, whether from the previous years or it from the current year. And the third option is he can purchase a capital gain bond. That is up to a limit of 50 lakh rupees. One thing I missed out to say that when I'm saying he can invest and buy a new property, there's a capping which an NRI has to maintain. That is, the capping is maximum up to 2 properties he can hold. That means if I say, to describe it in detail, if I sold the property today and I want to offset the capital gain, that is the actual gain which is coming after doing all the maths and all. Suppose the gain is 100 rupees, which I'm talking about. That 100 gain rupees he has to invest in the next property, which has to be a residential property. It cannot be a commercial property, one thing. Second point is that if I'm talking about the residential property, when he's buying a new property, at that point of time, he should not hold more than 1 property. If he's holding more than 1 property, that means 2 properties he's already holding, then he cannot offset the capital gain against the residential property. So at the time of buying a new property, to offset the capital gain, he should hold only 1 property, and second property has to be the new property which he is buying to offset the capital gain. Now, that capital gain property which he is buying, it can be under construction property or it can be a constructed property. And the payment, that is the gain which we are talking about, 100 rupees, has to be put into the new property within 2 years from the sale of transfer of property which he has sold to the buyer, against which he is getting the capital gain offset against this property.
That was a fantastic, clear answer that you have given, Mr. Garg. Now, the question is, when somebody sells the property, how does one compute the short-term or long-term capital gains tax? What is the methodology adopted? Can you explain this?
How we compute short-term capital gain and the long-term capital gain. For the short-term capital gain, one needs to understand what is the sale price. Now, the sale price is basically the price which we have both agreed. Both agreed means the buyer and the seller both agrees and put it on the agreement to sell. That becomes the sale price. That is the actual value of the sale price. And now computing the acquisition cost of the property. Acquisition cost of the property is basically computing 3 things. One is the price paid at the time you have bought the property either to the builder or to the seller. Second is the registration cost which you have paid at the time of getting the registry done. In the registry, we pay 2 prices. One is the stamp duty and second the court fees. Both are included in this. And the third price we can add is the home improvement. Home improvement is basically the improvement in terms of renovation work which you have done, provided you have a supporting document for it. If you don't have a supporting document and you have paid it through cash, we cannot consider that. And lastly, in case you have paid any brokerage in check to the person through whom you have brought this property. All these 3 components becomes your cost of purchase. So that cost of purchase minus the sale price becomes the actual gain. Whereas if I different between the long term and the short term, in long term gains, basically all these costs which we have discussed in short term, we do the indexation on that. After taking the index cost of that value, then we minus the sale price. That becomes the capital gain value. So difference between the short term and the long term is, in short term, we actually minus the actual sale price minus the sale value. And whereas in the long term, the sale value get minus from the index value cost of acquisition of the property.
Welcome to File My Return. Let's begin with filing your ITR. Once you click on the link, you will land on our home page. Out here, choose from Sign In or Register. In case of existing user, click on Sign In. Else, Register. Feed in your name, email address, password, mobile number. Click I agree, sign in. Choose your residency status, whether you are resident Indian or non-resident Indian. Click on ITR filing. Choose a financial year. You can choose the current financial year or the 2 previous financial years. Now you will land on this page. Here you need to feed in your income tax login credentials, or you can skip, feed in your PAN number, then your password. Your details will be auto-filled in. You just need to simply verify each of them. Check and confirm, save and continue. Your address, save and continue. Identification and contact details, save and continue. Your banking details, save and continue. Select had a source of income in the previous year. Confirm your residency status. Feed in your resident country. Enter passport number. Feed in the period of stay. Click on save and next. Out here, you need to declare your income sources and upload the relevant document. Select from the drop-down menu. Choose the file you want to upload. Enter the password of the file. Enter any remark for the team. Press save and add more. A pop-up appears that document successfully uploaded. You can also view at the bottom of the screen. If you wish to add more documents, simply select from the drop-down menu, or else press next. On this page, click on the I acknowledge. Your best fit plan is visible out here. Click confirm and pay. Your ITR filing fee is reflected out here. In case you have any coupon code, put it out here. Press redeem. Press checkout. You will be redirected to the payment gateway. Choose the mode of payment. Click pay now. Once the payment is complete, you will receive a successful payment message and you will be redirected to the next page. Payment made successfully. Here you can view your invoice and also download the bill. So this is the process to file ITR for NRIs. For any queries, call on the given numbers below.
So all in all, when we talk about short-term and long-term capital gains tax, short-term is you pay a higher tax and you don't have an indexation benefit on it. In case of long-term capital gains tax, so you will actually calculate the indexed value of the property and the tax slab also drops down. So holding properties for a longer period of time is more beneficial. Somebody is trying to think that I'll sell it in 1.5 years. Probably it makes sense for him to wait for some more time. Wait till the long-term capital gains kicks in, and then you sell it, and it's more advantageous for our viewers. That's the point we have to keep in mind here.
Right, I totally agree. So basically, if I say the transfer date of the property is the main thing. If the person wants to do the agreement before the 2 years completion from the date of acquisition of the property, he can do the agreement to sell. We will not consider that agreement to sell as a sale date. We will consider only the date of transfer of asset in the name of the buyer. At that time, we will consider whether it is a long-term or short-term. So we have to first understand this thing. Suppose the person has bought a property on 1st January 2021. And if he wants to sell the property, considering that it falls under long-term capital gain category, in that case, the 2 years completion will be only after 31st December 23. That is from 1st January 2024 onwards. This property will become long-term. So he can do the agreement in the month of December 23 or November 23. And he can do the transfer in the month of January or post anytime after 1st January 24. In that case, it will become long-term. So there will be no issue. And he will get the benefit of indexation and everything. Otherwise, if he do the transaction and complete the transaction before 1st January 2024, in that case, it will become short-term capital gain tax. And in that case, he will not get any benefit of indexation on the payments which he has made at the time of buying the property.
Mr. Garg, you mentioned about the indexation benefit which is available on the long-term capital gains tax. What exactly is indexation? How it is computed? How it is beneficial for a seller to sell it at the indexed cost than at the actual cost, like in case of short-term capital gains. Can you elaborate and give a simple answer for understanding for my clientele?
Well, to understand this concept of indexation in long term, how it is benefit to the NRI selling the property or whether it is a resident Indian selling a property in India. if I bought a property at 100 rupees in year 2011, and if I'm selling the property at 200 rupees in year 2024, so basically, in a simple term, if anybody says that, what is the gain? What will anybody will do? He will say 200 minus 100 rupees. It is 100 rupees gain coming straight. It is not true. Whereas in income tax department, as per the law of income tax says, that 100 rupees with what you have paid in year 2011, on that they have given an indexation value, which we have to compute, taking that year base rate as 100, multiply by the indexation value which has been declared by the department for the current year, and what was the actual index value of 2011, that we divide. Then comes the index value. That means 100. Suppose if I say today the index value is 250 rupees, and at the year of 2011 the index value was 100 rupees. So what we'll do, we will multiply 100 into 250 divided by 100. Whatever the value comes in, that is become the index purchase price. That index purchase price is my purchase price today, and minus, what I'll do is I'll minus from the sale value the index value. That will determine whether there's a gain or loss. In case there's a loss, I can carry forward it for next 8 years. Whereas in case there's a gain, after minusing from the sale value the index value, that becomes my gain. So that I have given the option that the person can offset against the purchase of new property or pay tax to it, or offset to the carry forward losses which he has in hand. And lastly, by purchasing the capital gain bonds for up to a limit of 50 lakh rupees, and which is blocked for next 5 years. So that is the option, and that is the fair thing which the income tax department gives the NRI or a resident this option to take advantage of indexation.
In other words, to say that indexation is arrived at looking at what is the inflationary scenario in the country, and the indexation numbers are developed based on the inflation. So for anybody who is paying taxes on index benefit, it means to say you're not paying on absolute numbers. You are paying on genuine gains that you have made. You are given a benefit that the money what you have invested has lost its value because of inflation, which is captured in the indexation number. The true gains, whatever you have made, you are paying a tax on those. So it's always beneficial for someone to go for the long-term capital gains tax if they have an option and make best use of this. Mr. Garg, many times I feel NRIs are penalized because they have to pay a huge TDS, whether there is a profit, whether there is a loss, whether it's a short term, whether it's a long term. You have to pay 30% or whatever that figure you told, TDS upfront, and later on you claim or do whatever it is later on. But it's a hefty figure. By any stretch of imagination, it's a pretty hefty figure. Why does the government do it? Why can't they give the same parity? After all, NRIs are Indian citizens. Why can't government do this? Why did the government? What's the logic behind this?
Yes, Dr. Chandrakant, but I totally agree with you. But the reason why the government has introduced this section and imposed it on the NRIs, that when they are selling the property in India, the withholding tax should be higher than what the resident individual pay. The reason behind is because today, when an NRI sells the property, he immediately takes his money abroad. And in case there is any gain, just to give an example, if an NRI is having any gain in his property and he takes away the money abroad by paying only 1% TDS, what the normal resident individual is paying, how will the government recover the TDS or the tax liability which has been there on the gains which he has made when he has sold the property in India? That is the reason the government has imposed it, because there is no mechanism for the Indian government or the Indian income tax department to recover the tax on the property sale transaction which has happened in India by an NRI, because he has taken away his entire money abroad when he sold the property. The very next day or the very next month, he takes away the entire money outside India. Our Indian government has no mechanism to recover the tax liability which is incurred because of the gain made by the NRI. And moreover, to have a transparency, the government is not saying that you don't have an option to lower this TDS liability which is coming out to be withholding tax of 20% or 30% because of the period of duration the property has been held. They have given an option. They are saying you can apply for the lower tax deduction certificate with the department to get this liability lower than what you are paying it today if you don't go for that. So there are mechanisms to lower this TDS value of withholding tax value of 30% or 20%.
Mr. Garg, you mentioned that there is a mechanism to lower this TDS obligation. Many NRIs do not know. They first sell and they go towards the registration and they suddenly come to a rude shock that you have to pay so much of a TDS. They'll be scrambling for money and they don't have time. They have come to India to execute this agreement. It creates a messy atmosphere. Instead, you said that there is a mechanism to lower this tax deduction, TDS part. How does it work? What is the guidelines government of India has done? A prospective seller of the property in India, the NRI, how he can make best use of this system. Can you give me the standard guidelines, what needs to be followed in this case?
Yes, absolutely. There's a way to lower the TDS liability by approaching a tax expert or a chartered accountant when you want to sell the property in India. The option is been given by the income tax department. That is by applying for the lower tax deduction certificate with the income tax authority. How it is done? And let me explain that. If you're selling a property in India, what you have to do, you have to first approach the chartered accountant or a tax expert who knows what he has to do with this transaction. One, he has to first approach to the income tax department with all the evidence that at what price you have purchased this property. And after doing all the maths, he will do the computation and determine what is the actual gain. Basis on that, after submitting the required documents or all the evidence supporting documents, he can approach to the income tax department for getting the LDC certificate. The department will verify these documents, and after verifying these documents, they will issue a lower tax deduction certificate so that your liability reduces from 30% to whatever the actual gain you have made. Now the question arises, will it come for 0%? The answer to is no. Still, the government has put a condition on it. The government says that if he has sold the property in India, in that case, the minimum withholding tax, even in case there is a loss while computing the actual gain or loss by doing indexation or whatever mechanism we do that, the withholding minimum liability will be of 3% plus surcharge and plus education cess. Why they are holding this amount? Because they want that while you take away this money abroad, even in case there is a loss or whatever, but you should file the return in India. That is, whatever the financial year you are following. Suppose if you are selling the property in this financial year, next year you should file your return and declare that you have sold the property in India and this is the actual gain or loss, whatever you have done. Basis on that, whatever the TDS has been held by the department withholding tax, you can claim back as a way of refund from them. Or in case there is a liability to be paid, you have to pay the liability to the department. So the minimum withholding certificate, that is LDC certificate, we can get up to a 3% value. So if we can reduce from 30% or 20%, we can reduce to up to 3%, even in case of loss also. But this 3% you can recover back in case there's a loss in the property. And in case there's a gain, then this can be offset against the TDS liability which you need to pay to the department. That can be offset against the TDS withholding tax which has been done by the buyer.
Applying for this lower TDS certificate probably involves certain time. Let's say somebody has to sell a property. Let's say he has to sell it in the month of January. How much is the lead time seller has to get this certificate? How quickly it can be done? What is your guidance to these people? When should they apply? What is normal timeline that they have to keep in mind? See, they have got into an agreement for buying and selling, and there will be haste in between. And if there is a delay in getting the TDS certificate, so it will complicate matters for the seller. So what is your advice to people? How much time that could be required? How they should negotiate with the buyer and the lead time that they have to keep in mind?
Let me address to that question. So coming to the point, how much time it will take? First of all, I would like to tell you there is no defined time as per the income tax guidelines. But yes, the answer is there. As I said, you can get the certificate within 1 month, provided there is a complete documentation ready what is required to be given to the income tax department. Now coming to what all documentation is required. One is the ATS, agreement to sell. Agreement to sell has to be duly signed by both parties, that is the buyer and the seller. That is the first most important document. Second document is property related documents. Property related documents, if I'm talking about, that is all the payments which we have made to the builder or to the buyer. We need the ledger copy or the receipts and the conveyance deed, builder buyer agreement, and the KYC documents of the seller as well as the buyer. And one of the most important document which we need is the TAN number. TAN number of whom? That is of the buyer. That the buyer has to immediately after getting the ATS, then the buyer has to apply for the TAN number. Once he gets the TAN number and all the documents are in order, we can apply for the lower tax deduction certificates. So normally probably the time takes between is 15 to 30 days from the date after of submission of documents with the department. So maximum time we can say is we can put into bucket is 1 month, provided all the things are in order. And one more important thing is the seller has to make sure, that is the NRI, his PAN is operative. In case his PAN is not operative, then this can stretch to another 15 days, because to get your PAN operative, it takes 15 days more from the date of applying. We cannot apply for the lower tax deduction certificate until unless your PAN is operative. So you have to understand. So once you do the ATS, you can simultaneously proceed for your PAN operative, and as well as the buyer can go for his PAN number. So these two things will take around 15 days. And from after 15 days, it will take another 15 to 30 days to get the complete thing. So you can take approximately 2 months from the date of entering into an ATS with the buyer. So what I suggest, any NRI who is selling the property, take ample time between 2 to 2.5 months at the time of doing the ATS with the buyer, that he is selling the property. He should take that much of time, because otherwise it will become very troublesome for the NRIs that they have a crunch time. As Mr. Musk told, that there's always a crunch time. They need time, and what is the timeline they should follow. So I particularly suggest that it should be between 2 months to 3 months. This is what the ideal time in which we can complete this transaction and get the lower tax deduction certificate for the NRI.
One question that comes to my mind is, somebody applies for a TDS certificate and they get a TDS certificate in 30 days time. Suddenly, the deal gets into a complication and they are not able to complete the deal within the stipulated period of 2 months or 3 months. Suppose if this deal gets extended and gets registered at a future point of time, is there a validity for the TDS certificate which is issued that, okay, it is valid only for such and such a period? If the timelines are crossed, you have to reapply for a TDS certificate?
Yes, there is a timeline. This certificate is valid for 1 financial year. That is, 1 financial year means if I am applying the certificate in the month of January, then it will expire by 31st of March 24, if I'm talking about the last financial. If I'm talking about the certificate being applied in this financial, that is financial 24-25, it will get expired by 31st March 2025. So the timelines is for 1 financial year, complete financial year. If we applied in the month of March and get the certificate in the month of March itself, the registry has to happen in the month of March itself, because the certificate validity is till 31st of March. And in case the certificate get expired, now the question is, can the person reapply for the same thing? Yes, he can apply and get the new certificate with the same person name, or it can be a different buyer also. In case the deal gets called off, suppose if I say the buyer is not interested to purchase this property, now what? Is it a compulsion me to sell it to the buyer to whom I have entered into agreement? No, the department is not forcing you. You have just got the certificate. It is not a final number. As I said, the withholding tax is 3% even in case of loss. So department says it's not a compulsion. It's not a bounding to sell the property to the existing buyer whom you have got into an agreement. In case there's a tussle, you can definitely cancel the agreement. The certificate will automatically become invalid, because if you are not available that and utilize the certificate, it will be null and void after 31st of March, the year it is getting ended.
Dear viewers, a lot of you have reached to me through a WhatsApp message stating that you are looking out for filing the tax return, looking out for lower TDS certificate, looking out for chartered accountant services for repatriation of money. We have heard your request. Now we have built a team of panelist chartered accountant who can assist you. If you are looking for any services from chartered accountant for the tax related issues in India, you can make best use of services provided by our panelists. You can send us a message through WhatsApp. Our number is given in the description box below. Our WhatsApp link is also given below there. So you can just click on the link. It takes you to the WhatsApp. Send us a message on the services that you need, and we'll be happy to assist you by connecting you with a panelist chartered accountant in the city or in the region where you are located at. Make best use of this, and you can avail these services. Mr. Garg, one situation I'll tell you. Let's say somebody has not applied for a lower TDS certificate and he paid the maximum TDS as defined by law. Now, can he get this money back under any circumstances? Can he apply? Can he file tax return and claim back this money? Or are there any hindrances? Are there any points that he has to keep in mind? People have done TDS and they forget it. And they come back after 1 year and say that, oh, I forgot this money. It's a big chunk of money. I didn't have time. I can apply now and get it. What are the points people have to keep in mind?
As I said, any withholding tax which has been done on the sale of property, which has been sold by an NRI, he can claim the refund, provided there is no gain or there's a gain which is not as per the actual TDS been withheld. Suppose if I have made a loss while selling the property and the withholding tax was 20 rupees, I can claim back. Entire 20 rupees, the department will refund it with interest to the NRI, provided he files his income tax return after the financial year gets closed. That is, suppose if I'm talking with the person who has sold the property in last financial year and the transaction has been completed before 31st of March, that is transfer of property in the name of the buyer. In that case, whatever the withholding tax been deducted by the buyer, he can claim it before 31st of July. He has to file his return and the department will start doing his, will process the return according to the income declared by him and whatever the tax liability he has to pay and has been fully paid. What are the excess TDS been held will be refunded with interest to the SSC. Now, coming back to the second question, that in case the TDS, whatever the tax he has paid in India, he will get the benefit of same wherever he is filing his return outside India. In case if he is declaring that this is the gain which has been done in India, he can claim the TDS which has been withheld in India in abroad also. So there is a double taxation treaty which we have signed with almost all the countries and we can get the benefit of that. So in the end, I'll say that all the NRIs who are selling the property in India must file their return once the financial year gets closed. Otherwise, this money will be treated by the government of India as black money because they don't know what was the actual gain you have done, whether it was a gain or a loss. So it will be treated as black money. So it's better you file the return, comply yourself and get rid of this burden of black money and your TDS money which has been withheld by the buyer, by the department. You can get that refund back from the income tax department provided you file the return in time. That is 31st of July. Every financial year getting ended on 31st of March.
Do you mean to say if somebody has not filed a tax return in the following year by 31st of July, then they can't make a claim on this TDS beyond that point?
He can claim, but with the penalty, but that too with the time limit being mentioned. That is till 31st of December, he has to pay a penalty of 5,000 rupees. And in case he missed the 31st of December, then he can file it till 31st of March by paying 10,000 rupees penalty. But beyond 31st of March, if he files the return, he cannot get the refund back.
So the best course for NRIs is to, prepare yourself well, apply for lower TDS certificate, get all these things organized and pay whatever is due with that minimum 3% TDS. That's the best recourse than to, commit that big chunk of 30% of the sale value as a TDS, wait for 1 year and in the interim you have to do all these things. Probably lower TDS certificate is the best solution the government has given. So on one side it has made a disadvantage that you have to pay a higher TDS. On the other side it has also given you a benefit. Probably they should get hold of the service providers in the industry, apply for lower TDS, and that's the best solution I feel.
Yes, I personally feel the person should apply for the lower tax deduction certificate instead of going to the department and asking for the refund, because it's a cumbersome process. In case you miss out the date or in case the department find out any tax liability which is being due, the department to give you money back, they will go in deep and see each and every document, each and every records of your past. Had you fully complied with all the information, all the things which you have to do in past, they will dig out each and everything. So it's better that you apply for the LDC certificate and pay as the required tax which is required to be paid, instead of getting your money stuck of 30% or 20% of the sale proceed, which can be a huge amount. And to get that release from the income tax department will be another task, another challenge. So my suggestion and my fair advice will be that you should apply for the LDC certificate and wait. Don't rush for it to sell the property. You have come here, you have to come again after 2 months. I know it's a hassle, but it is better that you should apply for the LDC certificate. One last question I will address on this is that there is no need to come and physically present or go anywhere income tax department for the LDC certificate. The tax expert or the chartered accountant can manage your show even if you're sitting abroad. You don't have to visit anyway. You just have to send them the soft copies. Rest will be done by your chartered accountant or a tax expert. So there is no physical presence required. No physical involvement of yours is required with the income tax department to get the LDC certificate. Only the documentation has to be given to your tax expert or a chartered accountant. They will manage the rest of the things for you. And the LDC certificate will be issued to you.
Mr. Garg, I don't like to ask this question, but I have to ask this question. There are a lot of people whose PAN does not reflect the NRI status. They come to India, they suppress the fact that I am an NRI to bypass this tedious obligation. There are dime a dozen advisors who will say, "De kliya jayega." Okay. So what advice do you have for these people who suppress the fact, sell the property, get away with lower TDS certificate? What consequences might follow? Is it worth taking that route, or how do you want to handle this situation?
Interesting question. I will say those who want to do that, must try that. And after that, the consequences they will come to know. But that's the joke apart. I'll come to that question and address it in a proper way. There's a huge complications. There is a huge problem which the NRI will face. One, once he is taking the money abroad, he has to declare to the bank what was the source of money from where you got this money. That is the point number one. Once the government will come to know. Second thing is repatriating the money from India to abroad. He has to take and obtain a certificate from the CA. That is called 15 CA-CV form, which he has to obtain from the CA. When he go to the CA has to issue a certificate to him that this money and give him on his letterhead that this money is clean and everything and all that thing. Then only he can take the money abroad. But no CA will issue a certificate provided he comes to know this particular points and all that. Then it will become a problem for him that he will not be able to take the money abroad. That is the problem number two. There will be many people who will be saying that I don't want to take this money abroad. I'll be keeping the money in India. Agreed. But boss, when you file your return in India, you will not be hiding your status. You will be stating your status is NRI. In that case, you will be in trouble again. At one or the other point, you will be caught by the department, and at that time, it will become a problem for you as well as for the buyer who has bought your property. Why did he deduct 20% which he was supposed to? If the buyer has been at the fault, you are also at the fault because you have not declared what was your status. The status will be automatically known to the department. One, at the time of filing your income tax return. Second, if you want to repatriate your money to abroad. Third, in case the money which is coming to your bank account, this will be reported directly to the income tax department by the registrar, and second, by the banker, that this much of money has come and that this person has sold a property by the registrar to the income tax department. Then there will be again a question mark by the department. What is your status? And that time you'll be saying the truth. So this is a saying that anybody who goes to the hospital, he will tell the truth, each and everything to the doctor, that I had a headache also 10 years back, which he never tells when he buys an insurance. So this is when the income tax case will open up. At that time, you will say this thing that I was an NRI status in that time. You will be big time screwed up. So it's better, do not hide these informations. Tell the truth to the buyer. And when you are selling the property in India, it will lead to a lot of consequences which you will face later on if you don't declare it to the buyer that I am an NRI.
Thank you, Mr. Garg, for all these inputs. I presume we have done a comprehensive video for the benefit of those NRIs who want to sell property, and a legal correct answer to lower the tax obligations in a rightful way. Thank you very much for your kindness to come on the show and brief all these things for the benefit of my viewers. We remain in gratitude to you for your kindness. Thank you, sir.
Thank you, sir. Thank you so much for bringing me on your channel, and thank you viewers to listening me. Thank you so much.
Dear viewers, hope the video that I have done today helped you to find answers about how can you sell the property with lower TDS certificate. If it did give you the right direction, please do not forget to give me a thumbs up. If you are a person who is yet to subscribe for this channel, please hit that subscribe button and press the bell icon. Do not forget to share these videos with your friends and relatives, near and dear ones, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another useful subject, with yet another expert next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.